Okay, so let's start.
All right, let's dive into one of the biggest, maybe the biggest, debate in all of finance. Can you actually beat the market? I mean, is it just a myth, a dream for the average person? Or is there a real mathematical way to do it? That's what we're going to break down today, the epic battle between myth and math. I mean, this is the question, right? For decades, the conventional wisdom has been super clear. Trying to beat the market, that's a fool's game. You hear it all the time. Just buy an index fund, set it, forget it. But is that really the whole story? That's what this explainer's all about. We're going to dig in and see if it's actually possible to find a real, repeatable edge. Okay, so first things first, let's really get a handle on that conventional wisdom. Because look, it's a powerful idea for a reason. It's built on a really solid foundation. This is the argument for why so many people say trying to pick winning stocks is, well, a fool's errand. And at the heart of it all is this thing called the efficient market hypothesis, or EMH for short. The idea is actually pretty simple. It says that by the time you hear some juicy piece of news, good or bad, it's already baked into the stock price. Why? Because millions of other investors saw it too, and they acted instantly. There's just no room left for you to get an easy advantage. So, according to this theory, where a stock price goes next is basically a random walk, totally unpredictable. And then Nobel laureate William Sharpe came along and just turned this whole theory into cold, hard math. And his logic is, well, it's pretty much airtight. Think about it. If you take all the investors in the world, both the active ones picking stocks and the passive ones just buying the index, together they are the market. So before you even think about costs, their average return has to be the market's return. But, and this is the killer part, the active investors pay way more in fees for all that research and trading. So after you subtract those costs, the average active investor has to, by definition, underperform the average passive investor. It's not an opinion, it's just math. So that logic feels pretty solid, right? Case closed. Game over. But what if the real world isn't quite as neat and tidy as that perfect academic model? What if there are some cracks in the theory? This is where things get really interesting. And this question really gets to the heart of the matter. See, those academic models, they assume a world full of perfectly rational robots making decisions. But we all know the real world is messy. It's driven by messy human emotions: fear, greed, panic, euphoria. And it's right there, inside all that mess, where opportunities can start to show up. So, yeah, day to day, the market can look completely random, just a bunch of noise. But if you zoom out over longer periods of time, clear patterns can actually start to emerge. And these aren't just random flukes, they're the result of those predictable inefficiencies we were just talking about. Things like those behavioral biases, or maybe fundamental signals that the market, in its short term frenzy, consistently overlooks. Okay, so if we accept that the market isn't perfectly efficient, then we need a new model, a better way to think about what's actually going on. And this brings us to a totally new way of framing the game, one that goes way beyond that simple active versus passive argument. Remember Sharpe's model? It was simple: two players, passive investors and active investors. Well, what if we use a more realistic model with three players? You've still got your passive folks who just track the market, but that active group gets split into two very different camps. You've got the smart money, the ones with a real systematic edge, and then you've got the dumb money, the ones who are consistently making mistakes. And here is the absolute key insight. For the smart money, active investing isn't a game against the market. It's a game they play against other active investors. And when you look at the numbers, it just clicks. So in this setup, the passive market trackers get, well, the market return, let's say 35.11%. But check out the active players. The smart money is pulling in a higher return, 38.46%. So where does that extra money come from? It's not magic. It is a direct transfer of wealth from the dumb money, who are underperforming, down at 33.44%. Between those two active groups, it's a zero-sum game. For every winner, there has to be a loser. This leads to a huge realization. The goal isn't necessarily to be a genius. The goal is to just not be the dumb money. If you can do that, you've got a shot. But how? Well, it's not about chasing hot tips or going with your gut. All the evidence points to one thing: having a repeatable, rules-based system. It all comes down to the power of process. And check this out, because this comparison is just wow. If you look at the SPI VIA data, which is the scorecard for professional active fund managers, you see that only about 35% of them managed to beat their benchmark over a 3-year stretch. That's the average Joe Pro. Now compare that to a truly systematic, rules-based strategy like the one from Satif. The success rate there? 83% over the same period. That massive gap, that's not luck. That is the power of a disciplined process. So, what does an edge like that even look like in the real world? Let's just imagine a process that could consistently generate an extra 10% of alpha a year. And alpha is just the fancy finance term for any return you get above and beyond what the market gives you. Now, I know, 10%. It might not sound like a giant world-changing number, but just you wait. The real magic happens over time. Because the secret ingredient to one that changes everything is time. The incredible power of compounding takes that seemingly small, consistent edge and turns it into something absolutely massive over a lifetime of investing. And boom, here is the punchline. Let's say the market gives you an average 8% return. Over 30 years, your $1,000 turns into about $10,000. Hey, not bad at all. But with that extra 10% alpha every single year, your total return is now 18%. That same $1,000, it explodes into $143,000. The difference isn't just big, it's literally life-changing. Okay, so we've laid it all out. A systematic process can give you a real mathematical edge. But now we get to the hardest part of all. Because the single biggest obstacle to actually getting that edge, it's not the market, it's not the fees, it's you. It's the person staring back at you in the mirror. Here's the problem, and we all know it's true. Even the absolute best strategies on the planet have losing streaks. They have drawdowns. And what's our human instinct when things start going down? To panic, to ditch the strategy, usually at the worst possible moment, and lock in our losses. The answer isn't to just try harder or have more willpower. The solution is having a disciplined process with preset rules that take the emotion out of it, like a rule that tells you exactly when to sell, forcing you to be rational when your brain is screaming at you to do the opposite. So let's wrap this all up. What's the new wisdom here? The old way of thinking said that passive investing was the goal, the ceiling. The new wisdom says, no, that's just the starting point. It's the floor. And beating the market, it's not about being a psychic and predicting the future. It's about having a better process and sticking to it. Real success comes down to three things: a solid system, enough time for it to work its magic, and most importantly, your own discipline to actually see it through. When you think about it this way, it changes the entire conversation. The question is no longer if it's possible to win. The question becomes how you're going to play the game. It stops being about luck and starts being about your process, your system, and your discipline. So the real question to ask yourself is, how are you going to play?
Okay, so let's go and look into some comments. But before that, of course, we have to do our little quiz. So I just need to copy it into our chat. Okay. And where do I copy it? I think it's here. Now I think I need to get stop sharing, right? And now I go back here to the chat. And here it is. So it should be okay. So let me just make sure that it's there. Okay, there you may start, and then we'll, when you finish, let us know. Okay. But meanwhile, I'll just go through it myself, but without answering, so that I don't embarrass myself. Okay, so let's go like this. And meanwhile, I think I also need to use the camera. Okay.
There is some problem with the link.
It doesn't work?
It asks me for access. It says I need access.
You don't have access? Do I need to have access? No. Wait a second. Where is this? So it asks for access. Does it mean that it's not in your?
Yes, and it says it if I'm a visitor, a guest, or a editor.
Oh, it suggests that you are a guest, or does it work like that?
I have to send a request.
Oh dear.
Some notebooks here.
Otherwise, probably don't manage to. Maybe I need to add your name here.
No, it didn't work.
Let me add your name here. So in that case, I need to add everyone to this. Okay. Let's see if you now have the permission.
Try again. No.
Not
No.
yet. Maybe
Not
I
yet.
didn't copy the right. Oh, I'll say I think this one was my fault. It was restricted here, and it should be able to connect even without the
Okay.
just with the link. I didn't realize that it was blocked on my side, the quiz. Let me see if now it's okay. Anyone? Welcome. Okay, I think so.
It's loading.
It's loading?
Still loading.
Okay.
At least trying to.
Is it working now? Not yet.
It's still loading.
Oh dear.
Let me close and reopen. Yes, now it works. Yeah.
It works. Okay.
Yes.
Meanwhile, I don't know why it's not working.
Now it's working.
Okay, good. Apparently I could actually show it here, not. Now it's blocked like that. Oh, I forgot to raise the table. Okay. Right now it's on. I think I can see it. Yeah, it's working on my side. Yeah. Okay, it's working. Okay, it's finished. To share. Okay. Okay, Zay, when you're ready.
Yes, it's almost finished. The last one. Okay, it's finished. Yeah.
Okay.
Thank you.
Okay, so we can begin with our small presentation. Let me just draw your attention to this spreadsheet I have here. What do I have here is a first problem that we need to consider, which is can we really believe that the most ETFs are able to replicate the market? So when we choose an ETF thinking that it is a proxy for the market, we need to check that. And we have done that in this spreadsheet for two big markets, the US market and the Japanese market. And you can see here on pink that the US market has about 5,000 stocks listed in the market. And if you look at comparing the return of the entire market, which we can do in our platform, with the return of the ETF in the case of the US, is the S&P 500, which has 500 stocks here, which is about 10% of this index represents about 10% of the market. Then you can see that in fact, if we take the average for these 4 years we have here, you can see that in fact the S&P 500 is a good replicator of the entire US market. So because this small difference in the SPY in fact overperforms the market slightly. So we consider that, in fact, we consider that a given index or ETF replicates the market if it has at least the difference is not more or less than minus or plus 1.5%. So in the case of the US, it is a good replication. So it's a good replication. It's not so in the case of Japan, you see, because Japan, which has almost 4,000 stocks listed in the market, we see that the difference there is again the Japanese market, which has 225 stocks, which almost half of the number of stocks you have in the US. It is doesn't replicate very well, but funny enough, on average, it does better than the market itself. So which means that beating the ETF in the US is more difficult than beating the entire market. But if you look at the difference on every year we have here, you see that there is a big difference. For instance, in 2022, the index underperformed the market by almost 5%. This year, it outperformed, last year, it outperformed the market by more than 6%. So there is quite a difference between the various years. But broadly speaking, these two indexes these two ETFs are probably slightly better than the market itself. So which means that they could be a tougher benchmark to beat than the entire market. But of course, investors may decide to choose not the entire market, but just a smaller part of the market, like we do here at SADIF. We usually select the only the top 14 what we call segments of the market. We divide the market in 25 segments based on the quality of the stocks and based on the also on the recommendations that we have for those stocks, and we split the market in 25 segments, and we select just the top 14 segments. So if you select the top 14 segments as we have here, we have only about 3,000 stocks in the US, and that is that this market segment is just about 60% of the entire market. In the case of the US, we have it's slightly higher. It's about almost 70% of the entire market, and if we select also just the top segments. So this is an approach that we follow and that investors can also follow to try to segment the market in those segments that are more better. One thing that we also need to look into when you look at ETFs is the weight of every of the top stocks. For instance, the top stocks in the US, which are NVIDIA, Apple, and Microsoft, represent about 20% of the market, of the index, sorry, 20% of the index, while in Japan, there are also free stocks that represent 26% of the market. So this is quite a big number, but it's not as big and that's problematic like in some other countries. For instance, in Korea, there are basically two stocks out of the 200. There are just two stocks that represent 50% of the market. So that's, if you have a market, an ETF like this, you have to bear in mind that there may be some overweight of some of the stocks. Now, the interesting thing is that we can work out statistically, we can work out how many stocks should be in an index on ETF to actually have a good probability of replicating the market. We did that calculation. We do that calculation for our countries, and you have the numbers here. And say in the US, you need, and this also an interesting feature is this change from year to year. It's saying 2022, the number of stocks necessary to replicate the market with a 95% probability chance. So it would be a good chance. Would be just 400, but some other years 900 stocks would be necessary. So if you want to play on the safe side, and you want to make sure that a market is fully replicated by an ETF, then in the case of the US, you need about 1,000 stocks. In the case of Japan, the variation is even bigger. Say you have between 600 and 200 and 300, basically. So in the case of Japan, you need at least 600 stocks to have a good chance of replicating the market. So these are things that one should bear in mind when considering the meaning of beating a market ETF. You know, we have to really understand how representative this ETF is and how close it is in relation to the probability of actually replicating the market return. So that's the kind of thing we do. Okay, from this initial presentation, now we should look at not the market replication, but we should look at how some people manage to beat the market. And of course, we look at the famous investor who everybody knows, which is Warren Buffett, who has a track record of 60 years. Very few people, probably none, have been able to invest throughout 60 years. But we have examined the performance of Warren Buffett relative to the market, and we'll look at that in a bit. But first of all, let me just remember that in the case of the US, we have several alternative ETFs, not so much in the other countries where we usually only have one index that is, and we see we have in the US the Russell 2000, the Russell 3000 here in this column. We have the Russell 1000, and have S&P 500, and you have the Dow Jones index, which has just 3 stocks. So as you would expect, those that are close to 1,000 or more stocks like the Russell 1000 and the S&P 500, they actually, on average, they are really very close to the market. So basically, they replicate the market. But if you look at the bigger, of some of the bigger stocks, stock indexes, we have, for instance, the Russell 2000, which is made up of just the small companies, while the Russell 1000 is made of large companies, large and medium companies. The Russell 2000 is made up of smaller companies. And you can see, of course, that such a selection is biased towards more risky companies. And of course, then of the deviation from the market is much bigger. In this case, underperforming the market by 7.5%. Again, if you look at the Dow Jones, which is the oldest and most probably well-known index, which only includes the 30 biggest companies in the US, we see, because it's a very small number of companies, we see that it also has it hasn't managed to replicate the market as well. So even in markets like the US, where you have plenty of choice, where you can choose smaller or bigger segments of the market to try to replicate, then you have these differences. Okay, so moving again to the continuing with this paper, you will find this paper. You can work out the math behind this, some of the numbers that were quoted in our little video. But let's see now at the big difference between what is necessary, because there's another thing that is important to retain, and this is a different perspective, which is how long do I need to be invested to be able to beat the market. So we have done that test to compare our backtesting strategies, and what we noticed is that the underperformance rate, we'll come back to this later on, was less than 17%, with a standard deviation of 20%, and the worst case that we had was a difference of minus of 57%. So based on this, and basing on an excess return of either 3% or 7%, so less than the 10% we spoke about in the during our presentation, what we can see is that we need, if we use this very good performance by SADIF, and if we only manage to beat the market by 3%, you would need 3.4 years, almost 4 years, to be able to be sure that we could beat the market. And if we have an excess return of 7%, would again be 3.48 years. But if we're going to be on the average, if you want to consider within one standard deviation, then the number of years would be between 8 and 9, or better, between 9 and almost 10 years. So you see, if you want to make, and with this kind of performance, if we want to make sure that an investor is able to beat the S&P 500, then it would require, within the 1% standard deviation case, would require between 8 and 10%. Sorry, 8 and 10 years, not percent. Of course, in the case of if you have a worst case scenario, if it happens, then it would require much more. We would require 12 years to be able. Okay, let's compare this with the average active fund manager in the US, and those who survive. As you remember, there are only about 30% active US fund managers that can survive during a reasonable a 3-year period. Then what we have is that on average, because the performance rate is quite high, 65%, basically only 2/3 don't on average don't beat the market, with a very large standard deviation. So in their case, we are looking at 15 between 15 to 28 years. We are looking at 15 to 20 years. And if in the worst case, we're looking at more than 30 years. If they have one of their worst cases, which in their case is 99% loss, they would need more than 35, almost 36 years to actually beat the market. So you see that this is really a huge difference. It's also a factor that should be considered. When we talk and we say repeatedly that we need to give time for compound interest to work, and that's true, but also we need to be realistic about how long it takes. And as you see, with a strategy like SADIF, it may take between 8 and 10 years. With the average strategy of active investors in the US, it would take 29 years. So that's a huge difference, right? Probably you may think a little bit of propaganda for SADIF, but let's then just move for a final to finally remember why we think that we can actually, not based on this stage, but it's still we can. Okay, that's enough for that. For now, let's move to the other presentation here. Okay. So let me just remind you why we think that one is should pursue a policy of trying to beat the market rather than just accepting the established consensus, which actually has some Nobel laureates behind this. I think we have spoken in the video has shown that as well, that one of famous Nobel laureate, which called William Sharpe, has claimed that it is inevitable that all those investors together, all the investors together that pursue an active policy must incur costs, because having an active strategy means that you have to spend some resources to do that, to use that strategy. Then his claim is that as a group, then they will underperform the passive investors, the one who simply buy ETF. So let's say in the US, we believe that the ETF can replicate the market. Okay, fine. So we can say that the right benchmark is the S&P 500 or the Russell 1000. And but then when you consider the group of all those investors that pursue an active strategy, in that group we have not only investors with I think I was without sound, right? Yeah. Not only investors who are how should I put it? Not only investors have a medium to long-term mandate and run funds like that, but also all the investors that are engaged in day trading and high-frequency trading and so on. So in this big group of investors, of course, you have to have two different categories of investors. You have to have those that are smart enough to beat the market and those that are not smart enough to beat the market. And of course, with that split of this group of the investors that are not passive investors, that they don't just have, if you split this group in these two categories, of course, then the smart investors have to beat the market. They have to earn enough to cover their costs. And to earn enough to cover their costs, of course, the other group, the ones the not so smart or the dumb investors, if you want to call them, they have to lose enough so that the smart investors are able to beat the market. But luckily for the smart investors, the number of dumb investors is much bigger. So if you consider that all these categories that have a very low probability of beating the market, like day traders and so on, and all the other investors that give up after a few years, so they are unable to retain their investors, and so they also, because they are not they're not having good performance, so they are much more numerous, because in the end of the day, even if you consider just the 10,000 active investors, or rather funds, the investors will be more. If you consider there's 10, so because only about 10% will do beat the market, so all the 90% or 9,000 investors, they will be generating enough losses to make the winners, the smart investors, have a very good reward, or very good campaign. So really, the question is not so much whether it should be passive or active. The need to be active investor, and if you are an active investor, you have to be on the smart team, on the smart group, and not on the dumb group. So, and that's why a strategy is essential. So let's look now why a strategy is indispensable, so that we can